Hi, I'm Hafiz again, and in this session we are going to talk about a very important area of the exam syllabus which is part of the decision making, and that's pricing. So here we go. Let's start. Introduction to pricing. As we know that pricing is one of the most important and sensitive decisions management takes on a day-to-day basis, okay, because the prices keep on fluctuating from the beginning to the end of the year depending upon a number of reasons. So first of all, let's have a look at what factors change the prices, what factors are involved while taking the pricing decisions. Okay, organizational goals. Okay, that whether the organization wants to generate more profit or organization wants to generate less profit, because there is a nature of organization as well. Some organizations are more into profit motives and some organizations are less into profit motives. Okay, some organizations are meant for social purposes and some organizations are meant for profit purposes. So that's the internal policy of the organization to decide what level of profitability they want. Okay, right? Price and demand relationship, which is very key area of this topic. Okay, we are going to look at in big details how price and demand are related to each other, because generally we know through the rules of economics in the market that when one of these forces go up, another one comes down and vice versa. Then competitors. Of course, our price is affected by the level of competition. If the competition is stronger, generally the price is down, and if the competition is slightly less, then the price may be kept at a higher level. Cost. As we are always aware of this costing, that cost is the key area of the price, because cost and with some profit determines the selling price. So if the cost goes up due to any reason, the value of the materials or labor rate, usage, okay, or overheads, it makes the fluctuation in price. Okay, so price and demand relationship is very important. Then cost is very important. Okay, being an accountant I'm talking about. Okay, product mix, what type of products we are selling. Are we selling in a mix or a bundle or a package, or are we selling products one by one? You might have noticed a number of supermarkets and shops and retailers, they sell product as a mix. Okay, you can buy the main product along with the accessories and it's created a package, okay, or 2-3 things as part of the package. Quality, of course, quality is one of the area where a number of customers like to spend money. Okay, if you ask me what is the definition of quality, always I get confused about it. Okay, some people consider quality is the usefulness of the product. Some people consider life or durability of the product, how long this product will last. Okay, and a number of people say no, that's all crap. Okay, who will use this product for 20 years? Okay, we want a change. As the fashion changes, we want a new product. As the designs and the society's norms and values change, we change the product. So we don't want to use this TV for 10 years. We may keep it for 2-3 years and then we will change it. We don't want to use this mobile phone for another 15 years. A new model will come and we will change it. So it applies in society. I'm not talking about everybody, but a number of people think in that way. And a number of people think in this way, that quality actually represents the prestige. Quality actually reflects the premium brands of the product. Okay, name of the product. Oh, because those people have that product, I should have as well. So you would find this prestige, okay, or premiership of the products in various industries. Okay, you can buy a basic car which does the same job as compared to another car which is maybe 10 times more expensive, which does the same job. Same job means it gets us from A to B. Okay, but with the names we spend money. Inflation, which is the economic or external factor, As if the inflation is rising in the society, price goes up. If inflation is going down, generally price comes down. Okay. And last but not the least, product life cycle. Okay. If the product is of short life, generally price kept is higher. And if the product is longer life, generally product price is lower in order to stay in the market for longer period and to face competition. And there are so many other things as well. These are just a few factors I have listed down. For example, local laws affect the price as well. Sales tax rate or duties and so on. Okay. Also, the supply of the product scarcities also affect the price as well. At the same time, you can think about weather or seasonality as well. So as the weather changes, price may be affected as well. A number of things, okay, or maybe the social events, okay, or special events in the society that affect the price as well. Okay, now there are a number of ways to calculate the price, okay. Number one, cost plus, which is very straightforward. All we need to do is we need to add cost. If it is marginal, then only variable cost plus profit. If it is full cost approach, total cost plus profit. So idea is cost plus price is simply cost plus profit. And I think I would sound a bit silly if I tell you what cost is. Remember the absorption costing, activity based costing, etc. We all know the meaning of cost. Adding the materials with labor, with overheads makes up cost. Okay. Demand-based pricing, which is very important, we are going to have a look at in a moment. Okay, based upon this economic theory to maximize profits in the short term. And then marketing-based pricing. So this is the area which you will have to read a little bit. It's all theoretical. Okay. Marketing-based approaches are generally those approaches which organization or management applies in order to generate profits in the long run. Okay, a number of issues. First of all, actually, let's have a look at marketing-based approaches or other pricing strategies before we look at the cost plus and demand-based pricing. Okay, so now these are some theoretical areas where there are no numbers, no technicalities, purely knowledge. So let's spend a few moments on this. These strategies. Market skimming, very likely to come in exams for 2, 3, 4 marks sometimes. Market skimming is when the aim of the organization is to generate maximum or highest level of profit in the short term, in the short run. Reason being, life of the product is very short. Okay, generally it involves technology products or these electronic type of products where the models are changed every now and then, mobile phones, etc. Okay, so when the life of the product is short, generally the price kept is very high. Okay, and the organization wants to generate as much profit as possible. Skimming is very suitable when the products are unique and the products do not have much competition. So whenever a unique product comes in the market, we know that people are queuing up to buy that product because they know that it will have limited life. Maybe in 6 months, 1 year, the product will be removed. Okay, and the new model will be coming. So many people like to buy the product straight away when it is launched, and they are willing to pay a higher price. Some of the features you can see here, generally low volume because price is very high. So not everybody wants to spend this money. So whenever the price is high, demand or volume is generally low. Okay, low initial investment in production capacity because we are producing lower volumes, so we don't need too much capacity to start with. Okay, it is low risk. If strategy fails, price can be dropped as well, but generally it happens that they determine the life cycle of the product that for a few months price will be high because they know people will be buying, and afterwards when the trends change slightly, then they can drop the price as well. Okay, so generally unique products come under the market skimming, right? Market penetration, which is the second approach. Market penetration pricing is when the price is kept slightly low to start with, because the aim is not to make all the money to start with. Okay, aim is not to make high amount of profit, large profit at the beginning. Aim is to make the people addicted. Aim is to get the people used to with the product. Aim is to get the people become part of this product, that they can't live without this product. So generally the price kept is very low. With the passage of time, price can be increased as well. Okay, but the aim is to stay in the market for a very, very long period of time. Okay, you can see the examples of products which your grandparents have used, your parents have used, and you are still using them. Okay, number of cereals you use in your breakfasts, and you can imagine how many years these cereals are in the market. Okay, different type of soaps or shampoos, you can imagine. Okay, generations are using them. Okay, again and again and again. Of course, slightly changes happen as well, but the brand or the product remains the same. So idea is keep the price low and focus mass market, meaning huge volume, higher volume. Okay, it involves substantial investment. Reason is because of the massive volume. Because of larger volume, it needs huge production capacity, huge warehousing capacity, hundreds or thousands of employees or workers to produce those products, many people to deliver the product. So it involves substantial investment. Okay, it is very risky in a way because you invest so much money. Okay, and if something goes wrong with the product, if customers don't like the product, okay, it will be very hard to recover the investment. Okay, and if you keep the price even further down, if you decrease the price, you may not generate profits. So it has some risks, but of course the product experts do sufficient research before they launch the product. Complementary pricing. Okay, these are generally the prices of those products which are sold as a complement. Okay, people buy a range of products. For example, if people buy a computer, okay, you would appreciate computer can't be run without sufficient softwares. So you may have to buy some other softwares in order for your computer to run effectively. Okay, for example, if you would buy shoes, a number of people may end up buying shoe polish as well. Okay, something like this. If you would buy a car, a number of people may buy car seat covers as well, something like this, which are complementary. Okay, so if the demand of main product increases, demand of accessories increase as well. Okay, next one is product line pricing. Product line pricing is that a number of times some products are related with each other in that line of the production. Okay, and when this happens, then a specific special price is introduced. Generally, some people call it a package price as well. Some people actually call it product line price as well. You might have seen, I don't know, I mean, I think you might, everybody is a customer. So you might have noticed a number of products. For example, if you go to the shops, grocery shops or supermarkets, you might have observed that a range of drinks, soft drinks, are displayed in shelves. Okay. For example, here is Coca-Cola, here is Pepsi, here is another cola, and here is another cola, or so on. Okay, and a number of times, you know, Coca-Cola, Sprite, and Fanta, and so on, you know, they are displayed as well. That makes a line of products. Okay, so a number of times I have observed while going to the supermarkets that if you buy two, you pay a different price. Okay, so it's like, okay, either buy this one or buy that one. Okay, that makes, so product line pricing strategies include setting prices that are proportional to full or marginal cost with the same profit margin for all products in the product line. So whether, I mean, our idea is whether you are producing Coke or Fanta, okay, so idea is the cost is more or less the same. Packaging is more or less the same, volume is more or less the same. So whether customer buys product A or customer buys product B, company ends up with more or less the same money. Okay, volume discounting, which is very straightforward idea that if a number of people place orders in bulk, they get some level of discounts, and if people place orders in small quantities, they may get lower or no discounts at all. So generally this is a marketing strategy that in order to promote our sales, okay, right, buy two and get the second, get the third at half price or so on, or buy one, get the second at half price, etc. Okay, or if you buy two or three, you will pay different price. Okay, so it's like buying in different quantities. Price discrimination, which you might have observed in your society as well. Okay, it is charging a different price to different customers of the same product. You charge different price to different customers. How it happens? Very simple. A number of times it happens that if your location changes, okay, people charge differently. I mean, I can give you one example that if you are living in location A and for example you want house extension, you want to put a new garden or new kitchen or any other refurbishment of your house, you contact any builders, okay, they come and they will give you a price quotation. And at a location B, if you want the same kind of thing, okay, builders will quote a different price. Okay, I mean, I can give you an example being based in London. If your property is in Chelsea and Kensington, okay, where most of the footballers and these celebrities live, builders will charge different price because they know these footballers and celebrities and these movie stars, they can pay as much you ask for. But if you are living miles and miles and miles away in Essex somewhere, okay, where people are not that rich as compared to some other parts of the country, then you would notice people may not be able to pay and the builders will keep price low as well. So it's like generally location, okay. You buy a cup of coffee in one place at a different price and the same cup of coffee from the same chain elsewhere, you may pay differently, okay, especially prices on motorways, etc. So these ideas, you just need to read only the knowledge, okay, no application at all. Here are the applications. Demand-based pricing. Okay, first of all, we are trying to understand the relationship between price and demand of the product. What we know so far is that both forces, demand and price, they relate to each other but in an inverse way. Okay, they have inverse relationship with each other, meaning to say if price goes up, demand comes down, or if price goes down, generally the demand tends to increase. So that's the opposite relationship. One factor goes up and another one has to go down. This is general trends in the market. Okay, we can have a look at this graph, which you can see actually a chart line on the screen as well, which is the demand based pricing, and this is called as demand curve. Demand curve. On x-axis we have quantity or demand, which is Q, and on the y-axis we have price or P. Okay, meaning to say when the price was at this level, quantity was here, and when the price was here, quantity was there. Okay, so you've seen this, probably this demand curve many times, okay, just to reflect the relationship between price and demand. Now interestingly, a few things we need to understand in order to derive the demand curve. Okay, demand curve is an equation which is always given to you by the examiners in the formula sheet, and that equation is P equals to A minus BQ. Okay, and examiners explain this as well. What do we mean by P and A and B and Q? They tell us, okay, all right. So please remember, A is maximum price when quantity is 0. So this is A. Okay. B is this slope or gradient of the demand curve. that what relationship exists between price and demand, meaning how much increase in price will happen which will affect demand. Okay, if we increase the price by 10%, will we have a reduction in demand by 10% or the other way around? Okay, something like that, right? So we need to determine this B, okay, by using a formula. So B, examiner gives us to calculate this value of B, which is change in price divided by change in quantity or demand. Okay, you don't need to worry, examiner will give you this formula completely explained. Right, now here is the understanding. What do you think about this A for the business perspective? Okay, because this F5 is performance management. What do you think about A? I think you are telling me that this is a point or price which any management should avoid, because this would reduce the profitability. Why? Because at this price A, absolute maximum price, not many people will buy the product. And if the demand is too low or almost zero, there is no revenue, there is no profit. Okay, so A should be avoided at all times. If we look at the other side of the demand curve, which is here touching the x-axis, okay, we see another interesting thing. Now this point is the maximum quantity, which is not explained in the books or here, but idea is this is another point, demand or quantity to be avoided. So top part is the price to be avoided and the bottom part is quantity or demand to be avoided. Reason being, this is such an absolute infinite quantity which we cannot produce. We do not have enough production capacities to produce this. And secondly, at this quantity, the price will be very, very low. And if the price is very, very low, we cannot make enough profits. So idea is not actually to keep the price very high or very low, or to keep the quantity very low or very high. Okay, idea lies in simply this: improve the performance of the organization. And how the performance of the organization can be improved? To set a most realistic or appropriate price. So an appropriate price, whether it is towards higher side or it's towards lower side, that appropriate price will generate maximum profits. And later on at the end of this session, we will see that appropriate price will be profit maximizing price, which we will develop by setting up an equilibrium. Equilibrium is a balance, okay, that neither very high price is in our best interest, nor very low price is in our best interest, nor very high quantity is good for us, nor very low quantity is good for us. So a balanced price and quantity will be the solutions. Okay, so this is what we are going to understand. So let's start it with little things. First of all, deriving the demand curve. So this is the formula provided to you in the formula sheet in exams. P equals to A minus BQ. B is change in price divided by change in quantity, which is the slope or gradient of the demand curve. And A is the maximum price when quantity equals to 0 or very low. Now here is little example to understand how do we derive the demand curve. By the way, examiner never mentioned what is this P and what is this Q. So I can explain to you here as well. Price, simply P reflects the price. This is a price and Q is quantity. But these are some specific price and quantities. These are not any isolated price or isolated quantities. Now remember please, this P and this Q is based upon past experience or past statistics. That if company was selling this product in the past, okay, how many units Q were sold at this price? Or if the price was this much in the past, how many units were sold by the company. So what companies do, when they set up the price, they collect statistics that at this price, how many units we were successful to sell, and then we change the price, let's say from 10 to 11. And if the price went up to 11, then how many units we sold. So P and Q are actually combination of price and quantity coming from the past statistics, okay, not alone price and alone quantity, okay. Here is the example. Biscon, a product sells 500 units at a price of 25 based upon their past experience, and 700 units at a price of $20 per unit. Establish the equation of the demand curve. So here we go. Let's have a look at demand curve equation, which is P equals to A minus BQ. Now, based upon the information provided, always calculate B first, okay, which is change in price divided by change in quantity, okay, which is, or in other words, difference in price divided by difference in quantity. Now, here is difference in price, 25 and 20, and the difference will be simply 5 divided by change in quantity or difference in quantity. One quantity is 500, another one is 700. So put them in the calculators in such a way you don't end up with negative answers. So please don't put them as 500 minus 700. Otherwise you will get a value of B as negative. And if you will get the value of B as negative and you take this, substitute this in this equation, two negative signs, what happens to two negative signs? They end up being positive, okay. So this negative sign is already there. So best is to avoid any mathematical problems, put them the numbers numerator and denominator in such a way that higher value first and then lower value after, okay. So higher price minus lower price and then higher quantity minus lower quantity to see the difference in price divided by difference in quantity. So that comes to 5 divided by 200, and here we go, 5 over 200 equals to 0.025, okay, 0.025. This is the relationship between price and quantity, okay. Now afterwards, once we develop this, now we can find out the value of A by substituting any of the P and Q combinations, okay. So whether you can substitute one combination or another, it doesn't really make any difference. Just make sure pick up a whole combination of price and quantity, meaning to say in this question there were two pairs or two combinations given. One was the 500 quantity and 25 price, and second combination or pair was 700 quantity and $20 price. Choose one of the two. So let me actually choose this combination, and the second one you can try while you are watching my lesson, okay. Let me try the first combination and you can try the second one. We both will get to the same answer. So when the price was 20, so here is P equals to A minus BQ. Now P is, let's say, 25. At 25 quantity was 500, okay, this is quantity, and equals to A as it is minus B, remember 0.2025, okay. Now this is what we get. So if you multiply this 0.025 into 500, we get 12.5. So it comes like this, 25 on one side, then A minus 12.5. And if we move this to the other side of the equation, but remember, if you are moving a negative sign to the other side of equation, negative will become positive, positive will become negative, okay. So here we go. Let's calculate A A equals to 25 plus 12.5, and that equals to 37.5, meaning maximum price based upon our past understanding, relationship or history. A is 37.5, which company should avoid. So demand function or equation of this company's product will be P equals to 37.5 minus B, which is 0.025 Q. Now this is how do we calculate. Now the interpretation, what if we have calculated this, what benefit does it give us? What do you think? We learned how to calculate P equals to A minus BQ, which is not too difficult at all. First of all, calculate B, and then substituting this B into any price and quantity combination, we can get A as well. But what's the benefit of getting A and B values? Well, here is the benefit. It answers many questions, but two are very, very important, which can improve performance of the company. Number one, question number one is that if, for example, marketing or sales team, remember target costing? You remember target costing? Yes, you do remember. Target costing is a process which starts with setting up selling price first. So establish selling price first. So for example, using target costing, you know the price, that this is my launching price, and you know A and B already. So if you know P, you have A, you have B, can you not find out this missing Q by putting, if out of 4 things, okay, 1, 2, 3, 4, out of 4 variables, if 3 variables are known to us, can we not find out the 4th one? Okay, so if management knows the target or selling price, they can determine appropriate quantity to be sold. How many units production team should be going to produce for the next period. Okay, this is the first question. Second is, what if we don't know the price and we are looking to find the price? Then we need to ask our production or sales team, how many units will you produce next month or next period, and how many units can you possibly sell over the next period? So if the sales and production teams, after having a meeting, they tell us this is what we are planning to produce and sell for the next period, now Q is known to us, can we not find out appropriate price for that quantity? That if they are willing to sell those number of units, this should be the most appropriate price, and that would maximize our profitability. Okay, so this was the demand curve and its usefulness. Okay, now we are looking at profit maximizing approach. Profit maximizing approach is that this demand curve is a basis to be used to develop profit maximizing price. Okay, I can write down some steps for you, okay, and then we will discuss and solve a question as well. Okay, so profit maximizing price. In order to calculate this profit maximizing price, step number 1, calculate demand equation, which is P equals to A minus BQ. Step number 1 takes literally 2 to 3 minutes if you do the practice. Okay. Now remember, we've just calculated this demand curve equation, which was P equals to A minus BQ. And what answers did we get from this equation? Remember, we've got values of B and A. Is it okay? Afterwards, step number 2. Okay. Equate marginal revenue and marginal cost. equate marginal revenue and marginal cost. I'll explain it in a minute, okay? After equating marginal revenue and marginal cost, you will get Q. After this step, you will be able to get Q. And then last step is substitute Q into P equals to A minus BQ, which is demand curve. You will be able to get P, which is the profit maximizing price. So very small little easy steps. Now we are going to look into them. We've seen demand equation already, so let me spend some time to understand the equating marginal revenue and marginal cost. Okay, first of all, what are they? Marginal revenue is incremental or additional revenue when we sell an additional unit. And marginal cost is variable or incremental cost when we produce an incremental or extra unit. So if one extra unit sold generated marginal revenue and one additional unit produced incurred variable or extra cost, okay? Idea is that this marginal revenue should be greater than the marginal cost, if not equal, okay? But it should not, marginal revenue should not be lower than the marginal cost, okay? So idea is that marginal revenue, okay, should at least be balanced with the marginal cost, that we are not making much money, but at least we are making sufficient money to cover the extra cost, okay? And that helps us to maximize the profits. Now let's understand marginal revenue and marginal cost in slightly more details, okay? You don't need to worry too much. Examiner will give us clear instructions. I will tell you in a minute, okay? Right, here is a marginal revenue and marginal cost curves, okay? So if here is the quantity demanded and here is the cost or revenues, okay? We can look at this here, marginal revenue okay, meaning to say is that when the quantity sold is very low, okay, revenue is low, and when the quantity demanded goes up, what happens to the marginal revenue? Okay, let me do it again. When the quantity sold, when the quantity demanded is, for example, less, marginal revenue is very high. And as the quantity demanded goes up, marginal revenue keeps on coming down, okay? Or actually, let me show you in a slightly different way the curve, which is slightly better way to explain from the scratch, okay? Remember the demand curve, which was demand here and price there. I remember it was something like this, okay? This is unitary demand curve, otherwise it is like this, okay? Demand curve is like this, but we use unitary demand curve. This was demand curve, okay? Let's take it from there. If I want to slot, or if I want to draw if I want to draw a revenue line or revenue sales line, remember in CVP analysis, sales line was something like this, okay? As the units increase, sales or revenue increases, okay? Now idea is simply this, that wherever the marginal revenue cuts the demand function, that establishes an equilibrium, a balance, meaning to say a very high price is not very good for us, and a very low price is also not very good for us. A very high quantity is not suitable, very low quantity is not suitable. So some balanced price and balanced quantity combinations must be there in order to maximize the profitability. Let's understand this with the help of a table before we look into some algebra, okay? For example, if I create sum uh, simple figures. Okay, here is price and here is quantity. I'm just assuming, okay, I'm just assuming when the price was, let's say 10, quantity was 1000. Is that okay? Right? Or quantity was even 100. Let's make it even smaller. When price was 10, quantity was 100. Just assume price goes up by 11 and quantity goes down to 90. Price goes to 12 and quantity goes down to 80. Price is 13, quantity is 70, 14 and 60. So you can see I am changing it at the same, okay, price is increasing by $1 and the quantity is decreasing by 10 units. Okay. Afterwards, what we are going to look into this is let's decrease the price. Okay. What if the price goes down to 9 and the quantity goes up to 110? What if we reduce the price further to 8 and the quantity increases further to 120, or even 7 and quantity goes further up to 130? What possible things may happen? Okay, so first of all is change in price and change in quantity. Is it okay? And you can see I was changing the price by $1 and I was changing the quantity by exactly 10 units at every interval. Now let me assume some more numbers. Let's say we are given variable cost. Okay, variable cost including maybe direct materials, direct labor, variable overheads, etc. You are familiar with the variable cost. Let's assume whether the price is $7, $8, $9 or $10, variable cost is $5. I'm just assuming a simple figure you wouldn't even need calculators for. Okay, variable cost is 5 regardless of what price we set. Okay, because value of materials will not change, value of labor will not change. Let's assume it is constant. Okay, now let's calculate total contribution at each level. At each combination, let's calculate total contribution. Remember, selling price minus variable cost is contribution times by quantity equals to the total contribution. So let's pick up the calculator. Okay, so 7 minus 5 is $2 contribution multiplied by 130. So contribution comes to 260. Okay, let's calculate all of them. It will take 1 minute. You will see something interesting. Okay, 3 into 120 is 360. Then 4 into 110 is 440. And then all I'm doing is selling price minus variable cost contribution, then multiplied by the number of units. So 10 minus 5 is 5, 5 into 100 is 500. So at the moment it looks like as we are increasing the price, our contribution or profit is increasing. Okay. Then 11 minus 5 is 6 into 90, which is 540. And then 12 minus 5 into 80, which is 560. And then 13 minus 5 into 70, which is 560. And then 14 minus 5 times 60 is 540. And let me do one more. If the price went up to 15, units went down to 50, variable cost remains the same. 15 minus 5 times by 50, it comes to 500. Oh, did you notice something? that up to a certain level, the contribution or profit was increasing. And then when the price and quantity reached to a certain range or combination, the profit or contribution started falling. Okay, it was increasing up to here and then started falling. And if you keep on doing like this, price to 16, price to 17, price to 18, you would notice your contribution value will keep going down. Okay, your contribution value will keep going down, because what we are observing is that how much extra revenue we generate and how much extra marginal cost we incur. Okay, and what we notice that up to a certain level of price and quantity combination, profits can be maximized. If we reduce the price, that's not good for us. If we increase the price, that's not very good for us either. Okay, so a certain range of price or certain amount of price is only working in the best interest of the company. Now, of course, in exams we can't do this trial and error. I was just showing you that that's how a number of companies develop spreadsheets and they can find out the answers. Being an accountant, we can use a little bit of algebra or a little bit of maths and we can find out the answer even more quickly. Okay, and what we consider is, we consider this equating marginal revenue and marginal cost. Equating marginal revenue and marginal cost. Please remember, for your exam purposes, marginal cost is always variable cost. Okay, only variable cost is the marginal cost. Whereas MR function is given in the formula sheet of the exam paper, MR equals to A minus 2BQ. Okay, you don't need to worry about deriving MR function. Okay, it's given in the exams, just need to apply this. Only you might have noticed some similarity between MR and demand function. Remember, what was the demand function? That was P equals to A minus BQ. And what is the difference, did you notice? Only this two. Because what we believe is that slope of marginal revenue is twice the slope of marginal cost. Okay, slope or gradient of marginal revenue is twice the slope of marginal cost, twice the slope of demand curve. Sorry. Okay, so slope of marginal revenue is twice the slope of demand curve. But this function is given, we just need to learn how to apply it. Is it okay? Now let's have a look at an exam question and then we will apply those 3 steps. Okay, 3 steps I can show you again. These ones, profit maximizing steps. Okay, let's have a look at an example called Optim Limited. So it says exam standard question. Optim Limited makes a single product, a washing machine. The standard cost card for a machine is as follows. They've given us materials, labor and variable overheads. So these are, can I define them? These are variable costs. Okay. Output for the month is budgeted to be 5,000 units and monthly fixed overheads are expected to be $100,000. Fixed costs are expected to remain at this level of output, if output rises to 7,500 units per month. So meaning to say, even if we produce 5,500 units, 6,000 units, 6,500, 7,000, our fixed costs will remain the same. That's the definition of the fixed costs. The company currently uses a full cost. So currently, at present, company uses full cost approach to pricing and adds 100% onto the full cost per unit to calculate selling price. So whatever the full cost is plus 100% profit markup, they arrive at the selling price. This is cost plus. However, sales volumes and profits have been disappointing. Therefore, the company commissioned some market research to determine the relationship between costs and volumes. The research showed that a price of $250 per unit, sales would be 6,000 units per month, and would reduce by 500 per month for each $10 rise in price. So if the price set is 250 for a washing machine, units sold will be 6,000. But if we increase the price by $10, the demand or quantity would fall by 500 units. And it applies both ways. If we decrease the price by 10, the quantity will go up by 500. It works both ways. Now here are the requirements. A is using the company's current full cost plus approach to pricing, what selling price are they attempting to charge? That's the first requirement, cost plus. Full cost plus. Okay, first of all, variable cost. Variable cost is direct materials, labor and variable overheads. So 50, 30 and 40. In total 120. Is that okay? Now here is the fixed cost. Now what we are given about the fixed cost, that company is spending $100,000 and the normal level of budgeted level of activity is 5,000. So 100,000, remember absorption costing, budgeted overheads divided by budgeted activity 5,000 units. And you can see it works out $20 of fixed overheads and the full cost comes to $140. Then we need to add profit. They said profit markup is 100%. Okay, it's slightly too lavish, but anyway, it's the company's policy. 100% of 140 will be the same. And at the moment, current selling price is $280. That's the current selling price. Okay, requirement A done. So they are selling whatever number of machines at $280. Afterwards, requirement B. Derive the demand function or the equation and use that to calculate the monthly profit based on cost plus approach to pricing. Now there are two things. Okay, first of all, derive the demand function P equals to A minus BQ, and then use that, meaning use that demand function to calculate monthly profit. Profit is revenue minus cost based on cost plus approach to pricing, which we have done already. So let's do things one by one. First of all, derive the demand equation, which is P equals to A minus BQ. Okay, right. So here is P equals to A minus BQ. First of all, let's calculate B, which is change in price divided by change in quantity. That $10 change in price will change the quantity by 500 units. So 10 over 500 equals to 0.02. And now let's substitute this 0.02 into the demand function by picking up any price and quantity combination. So what they gave us was here. Market research showed that at a price of 250, sales would be 6,000 units. So this combination was given to us. When the price is 250, quantity would be 6,000 units. And A as it is, B is 0.02 times by Q. Okay, so that fraction you can work out, times by 6,000, that comes to 120. So 250 equals to A minus 120, and then A equals to 250 plus, because this minus sign will go to the other side to become positive, and that comes to 370. So demand function of this company is P equals to A minus BQ, okay, which is 370 minus 0.02 Q. This is first part of B. Second part is examiner is asking us use this demand function which we have derived to calculate monthly profits based upon cost plus approach to pricing. Remember, in requirement A, cost plus approach, price was 280. What if the price set at the moment is 280? How many washing machines we can sell? We can calculate the quantity. So 280 equals to 370 minus 0.02 times by Q. Okay, now everything is there, we just have to calculate Q. Okay, you need to use your scientific calculators and it will give you in one go. If you bang all the numbers in the calculators, you can get the answers. But I can just explain to you briefly, which you don't need to write these step by step in exams, okay? Just to, some people are slightly poor in maths like me, okay? So for them people, otherwise just bang them in the scientific calculators, you can get the answers. So it becomes like this, 280 equals to 370 minus 0.02 Q, okay? And what if we move this to the other side of the equation? It becomes 280 minus 370, and on this side we have 0.02 Q, and it's negative. So it ends up with 280 minus 370, we get minus 90, and here is minus 0.02 Q. Now please remember, in the maths, if negative signs are on both sides of the equations, they get cancelled with each other. So you don't need to worry about. Now both sides divided by 0.02 Q. 0.02, okay? We can easily calculate the quantity. So 90 divided by 0.02, we get 4,500 units. That if they set a price of 280, which is cost plus price at the moment, they can sell around 4,500 units. And if this happens, what will be the profit? Okay, so here is the profit calculation. First of all, sales 4,500 units times by selling price 280, then minus variable cost 4,500 units times by, remember, 120 I think, and minus fixed costs, which will be $100,000, because fixed cost will not change whether we will produce slightly more or slightly less number of units. So let's find out 4,500 into 280, which is $1,260,000. Variable cost is 4,500 into 120, which is 540,000. And minus fixed cost, we end up with $620,000 profit. So our answer is simply this: if we set a price of 280 based upon our existing pricing policy, we will sell 4,500 washing machines, and this price and volume combination is expected to generate $620,000 profit. Okay, now let's have a look at requirement C. Equate marginal revenue and marginal cost to determine profit maximizing price, and then we will double check whether this is really profit maximizing price or it is just in theory. Okay, so here is equate marginal revenue and marginal cost. Marginal revenue function, as I said, it's always given in the formula sheet. You don't need to memorize it. It's very straightforward anyway, which is A minus 2BQ, and marginal cost is the variable cost. Marginal cost is always variable cost. A is 370 based upon this equation, this question, 2 as it is. Remember, B was 0.02 and Q as it is, equals to 120. Now let's play around with this and see what answer do we get. We can use calculator. So 370 minus 120 divided by 0.04, we get Q equals to 6,250 units. Okay, so by equating MR and MC, we've got the optimum quantity, most suitable quantity. Let's substitute this suitable quantity into demand function as a last step. Okay, so P equals to 370, which is A, minus B is 0.02, and Q we have just calculated 6,250. And let's see how much price does this give us. It comes to 245. So what it's telling us, if we use the demand function to develop maximum price or profit maximizing price, it will be $245. So theoretically what we are saying is, if we sell one washing machine for $245, we can sell around 6,250 washing machines. Let's double check what would be likely profit if this happens, that sell washing machines at 245 and sell to 6,250 units. Okay, so here is expected profit. Which is not asked in this question, but it can be a likely question for another 2-3 marks. Okay, sales 6,250 units, and now the selling price is 245. Okay, then minus variable costs, 6,250 times by, remember variable cost is 120, and then minus fixed costs. And fixed costs do not change whether we sell a bit more or a bit less. So here is my calculator, 6,250 into 245, giving us total revenue of 1,531, $1,531,250. And then 6,250 into 120, variable cost is $750,000, and then $100,000 is the fixed cost as well. So in total, maximum possible profits which we are expecting this time around would be $681,250. So management may change their pricing policy. They don't need to charge $280, which is too high price. Okay, they can reduce the price. If they reduce the price to 245, their volume will pick, their volume will increase. and based upon this, their overall profits will be increased as well. So this is how we apply the demand-based pricing approach in order to maximize the profits. So again, as usual, I give you the advice, okay, please read your study material, okay, textbook and the notes, then watch this video again, try to practice this question, and then any additional practice questions in the revision kit relating to this topic. And then also any problems, give us the feedback. Okay, take care, all the very best, and I will see you soon with another ACCA topic. Goodbye.